Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the International Financial Accounting Standards IFRS 2 Share-Based Payment, one of three. Hope you will like, share and subscribe our channel. International Financial Accounting Standards IFRS 2 Share-Based Payment, one of three. Share-based payment and introduction. IFRS 2 is a set of accounting standards that governs the accounting treatment of share-based payment transactions called SBPT. IFRS 2 is the accounting standard that outlines the requirements for companies to account for share-based payments. Share-based payments are a common way for companies to compensate their employees or suppliers by issuing equity instruments such as stock options, restricted stock units, or shares in exchange for services or goods. An expense is recognized when the goods or services are received or consumed, including transactions for which the entity cannot specifically identify some or all of the goods or services received. Share-based payment transactions are those transactions in which an entity receives goods or services from employees or other parties in exchange for equity instruments, such as shares or share options, or other forms of equity-based compensation. IFRS 2 requires entities to recognize the fair value of the goods or services received, as well as the fair value of the equity instruments granted as an expense in their financial statements. Important terms for share-based payment terms, that is SBPT, are agreed between an entity and counterparty at the grant date, which is the date at which the entity agrees to pay cash, other assets, or equity instruments to the other party, provided that specified vesting conditions, that is, these conditions that must be satisfied for the other party to become entitled to receive SBPT, are met within the vesting period, which is the period when vesting conditions are to be satisfied. In some cases, grant and vesting date is same. That's on a vesting date, which is the date on which the vesting conditions are met. For example, an entity grants 100 share options to each of its 100 employees on the 1st of January. Each grant is conditional upon the employee working for the entity over the next 3 years. In the above example, 1st of January of the current year will be the grant date. Condition upon the employee that is working for the entity is the vesting conditions, whereas 3 years is the vesting period and 31st December or third year of the third year will be the vesting date. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK. Thank you. Have a great day.